Hey all, welcome to this episode of A Good Problem to Have. I'm your host, Tyler Olson. Today, I wanted to share a few quick tips on how to manage a taxable account. 401ks and backdoor Roth IRAs usually get the first attention from new attending physicians, but for those of you that have disposable income sufficient that you're wondering what you could do next, the taxable investment account is usually a really great option to consider after all pre-tax contributions have been made to employer plans, or if you're self-employed, a solo 401k. If you're a high earner, self-employed person, perhaps an additional cash balance plan. On top of those, and back to a Roth IRA, taxable investment account is a great place to go. The taxable account is basically a savings account. Money can be put in and out as you wish. There's no limits. There's no tax advantages either. But it's not just a savings account. You can invest in it. So there's a few things to keep in mind, though, because of the tax activity exposure. First, you want to choose an array of investments that do not create an inordinate amount of taxable income, like high dividend-paying stocks, and certainly not bonds, because bonds continuously produce, in most cases, there's some specific types of bonds that don't perpetually create income, but most do, and that income is taxable. And if you're in a high income tax bracket, that's just going to be tacked on top. So the first tip, choose investments that have low income production. They're primarily growth. So we're talking growth stocks. Stocks that have low dividends or no dividends, but they have the potential to grow. By owning them in a taxable account, as long as you don't sell them at a profit, there's no taxation, even though it's in a tax-exposed account. So that's called being tax efficient, at least in one respect. Second, you got to be careful about some of the features that come with taxable investment accounts. They sound like they can be beneficial for you, and in a lot of cases they are, especially with the pre-tax accounts, and that's called rebalancing. Rebalancing is a way to shift asset types to the right percentage. So if you have rebalancing happening automatically and one type of asset grows a lot more than another, then the software will automatically shift some of the money from the higher performing asset to the lower performing one. Problem with that is that it can trigger automatic sells. And when you sell something at a profit in a taxable account, you're going to be paying either short-term capital gains. If you made the purchase and subsequent sale within 12 months, that is taxed at your income tax rate. If it's 12 months or longer, then it's taxed at the long-term capital gains rate, which can be anywhere from 0 to 20%. But for the lion's share of you all, they would be 20%. And this is a long-term game anyway, right? So we're not wanting to sell. So anyway, long story short, don't turn on automatic rebalancing in a taxable investment account because you don't want to create taxation. And then a few other things to keep in mind. You want to automate this wherever you can in terms of contributions and subsequent investment. It's very easy for cash to be held up, where you put the money in, and if it's not automated, the money's not going to get invested and it's just sitting in cash. And depending on the custodian you're with, now if you're with Fidelity, you might be earning 3% with their money market fund, but others like Schwab, for example, it's going to be at a very, very low rate, and your cash is just sitting there, right? So you want to get that money invested. I know with Fidelity's platform, you need to make some purchases through the transfer section of their platform, and you can go to the investment activity section and you can turn on automatic ETF purchases and have it pull from the bank that you've linked. So that's a great way to shift if you're doing 3,000, 4,000 per month and you're like, I want it to go into this index fund, this index fund, and this index fund, this amount into each one every time. It's going directly from your checking account to being invested. And that's a great place to be. And then, the last thing I want to mention in terms of strategy is that once you get, if you're at a place now, or if you will be at a place where you could have north of $500,000, you may want to research looking into direct indexing. Direct indexing is a more complex strategy where you're owning the individual stocks of a given stock index. So hundreds of individual companies, lots and lots of tiny positions. This isn't something that you want to do if you want to set it and forget it. And if you don't want to deal with this stuff, you don't have to. But if your taxable investment account assets are growing, it's worth considering because there can be some ways to both benefit from short-term losses if they occur and potentially reduce long-term taxable gains on the profitable positions that you have. So this episode is not about direct indexing, so I'm not going to go into the details, but you should look into it if your assets are growing that much, and definitely get tax advice from either an enrolled agent or a CPA, someone that can give you good advice on how to manage this sort of stuff if you're going to get into the more complex areas of taxable account investment management. And yeah, that's about it. Just keep in mind that this account, this is the early retirement fund. This is the financial independence recreational employment fund, where you could potentially work less in your 50s or early 60s because you can access the funds anytime, as I said. Whereas with pre-tax retirement accounts, there's rules about when you can pull money out, and you also have to manage required minimum distributions in your 70s. So if you're fortunate enough to have a lot of income and you're maxing out the pre-tax stuff, bolster that taxable account because that's going to create so much flexibility in early retirement and in even just 60, 65, 70-year-old retirement. It's an excellent, excellent tool. Anyway, that's it for now. Thanks for listening. We'll see you next week.